Welcome back to Dollars and Cents with Freedman Financial on North Shore 1049. My name is Marc Freedman. I'm President and CEO of Freedman Financial, located in Peabody, Massachusetts, right across the street from the North Shore Mall and just above Alto Forno Restaurant on 41 Cross Street. We've been in that area for a long time, in the Peabody area. I mean, that's where I grew up. I went to high school here. I was president of the Chamber of Commerce. My folks grew up here as well. We finally moved out about 20 years ago, moved to North Andover when it was time for us to have our own family, and that's where I live today. So lots of connections to the North Shore, to the Merrimack Valley area, where we provide, and we continue to provide, financial planning and investment management advice to individuals and families who live in that surrounding community, and we've been doing it since 1968. If now is the time for you to get serious about your financial planning, I'd really encourage you to give us a call. 978-531-8108, 978-531-8108. When I last left you, we were talking about emergency funds. If you missed our last episode, that's what we were focusing on, and how to calculate what you need to have the right amount of money in an emergency fund. But today I thought we'd mix things up a little bit. It is August, and the market has not been very smooth this month. In fact, I got a report that came out from LPL Financial. It was their weekly market commentary this week. And I thought it was very interesting. It said that, did you know that for the past 10 years, historically, August is the worst month in the market. So you can go back, look historically, over the past 10 years, it's been August. By the way, it's really remarkable what it's done. For the past 20 years, it's been a little bit of a mix, but the past 10 years, August, and I don't know what it is. Maybe it's because people are on vacation, not everybody's head's in the game. I don't know what it is, but it makes the market volatile. And what we've seen this past week has been the markets fall off a bit. However, I happened to be traveling earlier in the week, and I called Marion, my business partner. I said, you know, when I saw the market going down 500, 600, 700, I said, I'm rooting for 1,000. I said, I want this market to close down 1,000 points for the day. I think it'll be great. And you know why I think it would be great? First of all, we need it. The markets just can't go in one direction forever. But secondarily, the markets have dropped over the past couple days on stuff that has nothing to do with the United States. The thing about all this news is really China related. And I don't mind that, because when we have instances like that, whether it's China, whether it was Venezuela, whether it was Greece, whether it was India, whether it's Russia, those are all very, very short-term lived events. These become buying opportunities for those that have cash in their portfolios, in their bank accounts, that they want to put money into long-term investments. This is not for speculation. I'm not encouraging that. I never have encouraged speculation. But these little blips, and that's really all these are going to be, are blips in the market. These are opportunities for you, and they should not scare you at all. In fact, like I said, I was away this past week. I was in Charlotte, and I called at the end of the day. I called the office, and I said, "So, did we get any phone calls from people who were nervous? Because the market did drop. You know, it came close to hitting 1,000. Then it ended up down only 700 for the day. But we had a couple other days before there where it was down 200. A couple days after that was down 200. So the market's off a bit." And my staff said, it has been just as quiet here today as it has been all summer, which says something about our clients. It says something, I think, about our clients understanding that they're in this for the long haul, that markets do go up and down. It tells us, for our listeners here, it lets you know that at Freedman Financial, we are not speculative investors. We're not getting in and getting out. Though there will be buying opportunities. Sure, we are doing what's called dollar cost averaging for many of our clients. Many people who maybe have a rollover from a company and they go, oh my God, I got this big amount of money. Now what should I do with it? The market's so high. How should I handle this money? Should I put it in right now? No, we have a strategy that we put in place where we will re-enter your dollars into the market over 5 months, over 8 months, over 12 months, whatever is appropriate for you. Now, in reality, if we're long-term investors, should it matter when I put the money in the market? No, it really shouldn't. But there is that emotional component of you saying, you know, I want to feel like I'm doing this prudently, that there is a thoughtful approach to this. And so when you're dollar cost averaging through a firm like Freedman Financial, we're not saying, okay, on the first of the month, we're going to buy. No, what we're going to do is we're going to buy, we're going to set it up to say, okay, during the first week of every month, we're going to make a buy. However, If the market has just gone up again consistently for 3 or 4 months, we might say, you know what, maybe we'll hold off from making a buy this month. Maybe we'll wait because we know there's going to be some dips along the way. We'll be thoughtful in our approach. We're not going to be mechanical in our approach. And I think that's one of the things that distinguishes an individual financial planner, a certified financial planner who works with you not through some corporate this corporate program that they don't have to follow certain templates or guides or anything like that. They do what's best for you. And that's what we have done for all of our clients. We focus on building a strategy that's right, not only for your investments, but for everything in your financial life. And we find it to be extraordinarily helpful. Look, we had a client that came in for a review this past week, and they looked at their portfolio, and they know the market's been up for the year, up over the past 12 months, but their account was flat. And you might think to yourself, wow, Mark, you must have really heard it from the clients. I said, no, because when we met with them, we talked about the fact that we could have invested the money right now, all of it right now, or we could have taken a dollar cost averaging approach, buying a little bit every month, knowing that if the market continues to go up like it had been, you were not going to be the beneficiary of great returns for the first year. However, if the market went down and you had bought all at once, you would really have been hurt. So they said, you know what, I don't want to do that. We both agreed we would take the risk. And when we were reminded of the conversations that we have, and we're reminded because at Freedman Financial, we put everything in writing. We want to give you our advice in writing. So there's no, oh, what did he say? Let me be sure I misinterpreted what he said that way. No, 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 no. We're not going to do any of that. You're going to make sure that you know what you're doing. So one of the things that I want to make sure you know what you're doing is when you're buying an investment, that you know that when the investment professional, or even when you try to build your portfolio, you know that it's important to diversify, to put money in a variety of different types of what are called asset classes. Those asset classes can oftentimes be referred to as stocks, bonds, and cash. And then you can take each of those stocks, bonds, and cash and break them down to further subcategories. Now, many people say they've heard of large cap, small cap, mid cap, large value, growth funds, value funds, all of that. Well, what's kind of interesting is a report came out recently from, I'm trying to find it here, the Wall Street Journal put out this story about the fact that the market is up so much for the year, despite what's happened over the past week or two. Who cares what would happen there? The market's up pretty significantly, double-digit returns so far for the year. But it's been led primarily by 3 companies. When you hear about the market being up, they talk about the S&P 500, the 500 largest companies that trade on the market. But the market run-up has primarily been driven by 3 companies. And you may be surprised by one of them, because you've heard of this term, the FANG stocks. And if you owned the FANG stocks, Facebook, Apple, actually Apple and Alphabet, which is Google, so 2 A's there, F-A-A-N-G, Facebook, Apple, and Alphabet, Netflix, and, well, Google is there. You've done extraordinarily well. You've done better than anybody could have possibly imagined if that's what you own. They've been up and down, but the exponential growth of these stocks over the past 5 years has been tremendous. However, there's one stock that people seem to think isn't doing so well, but has actually done extraordinarily well this year, and that's Facebook. Well, I talked about Facebook as being part of the FANGs. Facebook has done well, but the one that has really surprised people is Microsoft. Who talks about Microsoft these days? When's the last time you said, oh, I got to get that Microsoft this or this Microsoft that? Yeah. But Microsoft, believe it or not, remains the largest company in America. Not Amazon, not Netflix, not Apple. And in fact, Apple is down for the year. So the 4 leading companies this year are Microsoft, Apple, Amazon, and Facebook. If you owned Netflix, if you owned Apple, if you own Netflix, you've really struggled. If you've owned other stocks, you've struggled. But what's really interesting is I'm not encouraging you to buy individual stocks. I want to leave that to the portfolio managers. The portfolio managers know when to get in and when to get out. You have no business buying individual stocks. I've been telling you that since I've been in the business, but certainly since I started being here on the radio. The average person should not be buying individual stocks unless, of course, you want to say, all right, I'll just risk it. We'll see what happens. But don't count that as your performance, because you're probably putting a small amount of money aside to buy a particular stock. You're taking a risk on it. Some people will talk about these crazy cannabis stocks or some other type of technology stock or whatever it is. I'm recommending nothing. I'm recommending that the fact that when you're building an investment portfolio, you're buying mutual funds or exchange traded funds, you're buying a well-diversified portfolio. I'm not recommending an individual stock. But here's something that's interesting. You know that you want to own large cap, you want to own mid cap, you want to own small cap. Yet when I look at the performance of what large, mid cap, and small cap has done, just on a year-to-date basis, on average, large cap has done extraordinarily well. Mid cap has done a little less than what large cap has done. But small cap value especially, they're really having a tough year. And so when you look at the portfolio that you have, even if it's just investments in large, medium, and small, and you say, why am I not up as much as the market? Well, that's because you were prudent. You tried to build a portfolio that had large, medium, and small, large, mid, and small cap funds. You wanted some value funds. You wanted some growth funds. You wanted a combination. And as a result, you offered yourself some protection. You just haven't felt that protection yet because the market hasn't dropped. But when the market drops, you'll find that you won't go down as much as the S&P 500 would either, perhaps. It's all part of the diversification strategy. And then you layer in the bond-based investments that you have and the international-based investments that you might have. That adds further and further diversification to your portfolio. It reduces the risk. It doesn't give you that stellar performance numbers when you hear the market's up X or the market's down poorly. You're not going to be on those extremes. You're going to be squeezed. You're going to be squeezed quite a bit. And that's important. What you want in retirement is to minimize the volatility in your portfolio. You don't want the big ups and downs. You want to hear when the market fell 10% for the month that maybe you're only down 5%. I think that would feel a lot better. But when the market's up 10% for the month, you're going, why aren't I up 10% for the month? Well, you can't have it both ways. It doesn't work that way unless you're really lucky. And that's not something, and luck is not something we're trying to do on this radio show. Luck is speculative. You want luck? Go to the Encore. See how you do. I don't know, you still got to pay that $22 for parking, which I think is the biggest ripoff. You go to any other casino in Vegas, in Atlantic City, it's free valet, right? They're willing to eat that cost. They're willing to let you spend your money in the casino. Yeah, I was not too happy about that. I decided to swing by the Encore a couple weeks ago. I hadn't been to the place, and I had my two daughters, Mindy and Alana, who are 23 and 21, and I had my son, Noah, who's 17. We figured, oh, we'll go check it out. Well, that's fine. I know we weren't going into the casino. We weren't going to do that, but I wanted to check out all the other stuff. You know, you got to see that, whatever, $18 million Popeye statue that's there, which I still don't believe it's $18 million, but it's, come on, really? Someone's willing to pay for that. I don't know what it cost someone to build that. But there's the carousel, there's a few things to see. I wanted to see what it was all about. And I go to pull in, and it's $22 to park. I said, yeah, I'm just going to be here for like 30 minutes. Well, I don't care, $22 to park. There's no way around that one, I guess, unless I went into the casino and I played some hands of blackjack or whatever and maybe got a red card or whatever it's called. But I couldn't do that because I was with my 17-year-old kid. We were just going to check it out. Well, apparently they don't want it to be a tourist attraction. They want you to go in and spend money in the casino. Understood. But I thought that there was, I was really surprised that they were going to charge me $22 to park. Nevertheless, I paid it. There are some stupid things we do with our money, and that was one of them, paying for parking at Encore. But here on this show, we generally try to focus on financial advice in a language you can understand. I hope you understand paying $22 just to look around is not a good use of your money. And with that thought, I want to take a quick break because I want to share with you an interesting story that talks about the ranges of returns of investments and why when you hear that the market over the past umpteen years has averaged, say, 7 or 8 or 9%, Here's why it's not likely that you're going to see those kinds of returns on an annual basis moving forward. We'll talk about that and more. You're listening to Dollars and Cents with Freedman Financial on North Shore 104.9.